The forgotten way to get a loan. Imagine walking into a bank today only to be told that your credit score doesn't matter because it doesn't exist. There are no online applications, no computerized approval systems, and no three-digit number deciding your financial future. Instead, the banker looks directly into your eyes and asks a single question: who are you? More than 100 years ago, that question could determine whether you received a loan or walked away empty-handed. Before modern banking transformed America, borrowing money depended less on paperwork and more on something almost impossible to measure today: your reputation. It was a world where trust was currency, a handshake could carry the weight of a legal contract, and one person's opinion could shape your financial future for years. Understanding how Americans borrowed money before credit scores reveals a forgotten system that was both remarkably personal and surprisingly unforgiving. During the 19th century and the early decades of the 20th century, America was still a nation built on local community. Small towns stretched across the countryside, connected by dirt roads, railroads, and growing trade routes. Most people spent their entire lives in the same region, surrounded by neighbors who knew their families for generations. In this world, your name carried enormous value. If you were known as an honest worker who kept promises and paid debts, opportunities often appeared when they were needed most. But if your reputation was damaged, recovering from financial hardship could become nearly impossible. Banks were very different from the massive national institutions people know today. Most were small, locally owned businesses serving only nearby communities. Bankers personally recognized many of their customers. They knew which farms produced successful harvests, which shopkeepers managed profitable stores, and which families consistently honored their commitments. Instead of relying on computer databases, bankers relied on years of personal observations and conversations with trusted members of the community. Lending money was as much about judging character as it was about counting dollars. For farmers, borrowing money was often a matter of survival. Every planting season required seeds, livestock, equipment, and supplies long before crops could be harvested. Many families simply did not have enough cash available at the beginning of the year. Rather than refusing to help, local merchants often extended credit based entirely on trust. A farmer could walk into the general store, collect everything needed for the season, and promise to repay the debt after harvest. The merchant carefully recorded every purchase in a handwritten ledger, creating a simple financial history one page at a time. Those worn notebooks became the closest thing America had to a credit report. Merchants understood that farming depended on weather, disease, and unpredictable markets. A poor harvest did not always mean a farmer lacked honesty. Because lenders knew their customers personally, they could distinguish between bad luck and irresponsible behavior. This personal understanding allowed many hard-working families to survive difficult years that might have destroyed them under a purely mathematical lending system. In growing towns and cities, business owners depended on similar relationships. A blacksmith hoping to purchase better tools, a tailor wanting a larger workshop, or a grocer planning to expand inventory usually approached local lenders directly. These meetings often resembled conversations more than formal interviews. The lender wanted to understand not only the business plan but also the character of the individual. Questions about work ethic, family background, and community involvement carried tremendous weight. Recommendations from respected citizens could open doors that money alone could not. Sometimes churches, civic organizations, and influential community leaders quietly helped determine whether someone deserved financial assistance. Ministers, school teachers, or successful businessmen frequently acted as informal references. Their opinions reassured lenders that the borrower could be trusted. In many communities, social reputation became a form of financial collateral. Losing the respect of neighbors could make borrowing nearly impossible, even if a person possessed valuable skills. Not every loan came from a bank. Wealthy landowners, successful merchants, and private investors regularly loaned money to people they believed were reliable. These private agreements were often sealed with little more than handwritten contracts and a handshake. Lawyers were sometimes involved, but many transactions depended almost entirely on mutual confidence. While this system created opportunities for honest borrowers, it also carried significant risks. Misunderstandings, broken promises, and economic downturns could quickly destroy relationships that had taken years to build. As America's economy expanded during the late 19th century, railroads connected distant cities, factories attracted millions of workers, and immigration transformed rapidly growing urban centers. Suddenly, banks were serving customers they had never met before. Entire neighborhoods were filled with newcomers whose reputations were unknown. A banker could no longer rely on conversations with neighbors to determine whether someone deserved a loan. The old system that had worked for generations began showing serious cracks. Businesses also faced increasing pressure to make lending decisions more quickly. The growing economy demanded faster access to capital. Merchants needed inventory, factories required machinery, and entrepreneurs wanted opportunities that could not wait for weeks of personal investigation. Handwritten ledgers and local gossip were no longer enough to support a nation becoming one of the world's largest industrial economies. America stood at a crossroads. The personal lending system built on trust had helped countless families achieve their dreams, but it struggled to keep pace with a rapidly changing country. Bankers, merchants, and business leaders all searched for a better way to measure financial reliability without personally knowing every customer. They believed a new system could make lending faster, safer, and more consistent. But everything changed when new methods of collecting financial information began spreading across the country, laying the foundation for a revolution that would forever change how Americans borrowed money. New methods began appearing during the second half of the 19th century as American businesses searched for a way to replace personal familiarity with organized information. One of the most significant developments came in 1841 when merchant Louis Tappan founded the Mercantile Agency in New York. Instead of asking neighbors for opinions every time a customer requested credit, businesses could now consult reports gathered from correspondents across the country. These reports did not contain a simple numerical score. Instead, they included written observations about a person's business reputation, financial habits, occupation, assets, debts, and overall reliability. For the first time, trust was beginning to move from local memory onto paper. As railroads stretched across America and telegraph lines connected distant cities, these reporting agencies expanded rapidly. Businesses selling goods hundreds of miles away could now make decisions about customers they had never met. The system was far from perfect. Reports could be outdated, incomplete, or influenced by personal bias. A misunderstanding or false rumor sometimes damaged someone's reputation for years. Yet compared with relying entirely on word of mouth, it represented a major step toward a national financial system. By the late 19th century, industrial America demanded more capital than ever before. Factory owners borrowed to purchase machinery, railroads borrowed to expand across the continent, and merchants borrowed to fill growing stores with products arriving from every corner of the country. Banks could no longer operate like neighborhood institutions serving only familiar faces. Lending was becoming a business built on information instead of personal relationships. Ordinary Americans experienced this transformation in different ways. A hard-working farmer who once depended on the trust of a local merchant increasingly found that written financial records mattered just as much as personal character. Shopkeepers who had always extended credit based on years of friendship became more cautious as competition increased and economic downturns became more costly. The Panic of 1873 and the Panic of 1893 reminded lenders how quickly fortunes could disappear. Banks that had trusted reputation alone often suffered enormous losses when businesses failed and borrowers could not repay their debts. These financial crises encouraged lenders to collect even more detailed information before approving loans. By the early 20th century, America had become a nation of automobiles, department stores, electricity, and mass production. Consumers wanted to finance furniture, sewing machines, farm equipment, and eventually automobiles. Department stores, electricity, and mass production. Consumers wanted to finance furniture, sewing machines, farm equipment, and eventually automobiles. Businesses needed quicker ways to decide who qualified for credit. Handwritten ledgers and lengthy personal interviews slowed the process. New reporting agencies gathered larger collections of financial information, helping lenders compare applicants more efficiently than ever before. Even so, every institution still used its own methods, and decisions often varied from one lender to another. The Great Depression exposed the weaknesses of America's lending practices on an unprecedented scale. After the stock market crash of 1929, thousands of banks failed, millions lost their jobs, and borrowers across the country struggled to repay debts. Homes, farms, and businesses were lost as foreclosures spread from town to town. The crisis demonstrated that evaluating borrowers required more than personal judgment alone. It also required consistent financial standards capable of working during both prosperity and economic disaster. In response, the federal government introduced sweeping banking reforms. Institutions became more regulated, lending practices gradually became more standardized, and financial records grew increasingly important. During the decades that followed, advances in mathematics, statistics, and computing made it possible to analyze financial behavior on a scale that earlier generations could never have imagined. By the middle of the 20th century, lenders relied less on personal acquaintance and more on documented financial history. This transformation eventually led to the development of modern credit scoring systems, including the first widely used FICO score introduced in 1989. Today, millions of loan decisions are made within seconds using digital information, algorithms, and automated risk analysis. The process is remarkably efficient compared with the world of handwritten ledgers and face-to-face interviews. Yet something valuable was also left behind. Earlier generations understood borrowers as individuals with unique circumstances rather than collections of financial data. A banker who knew a farmer's family for 30 years could recognize the difference between temporary hardship and chronic irresponsibility. Modern systems provide greater consistency and speed, but they cannot always measure determination, integrity, or the willingness of an entire community to stand behind one person. Looking back at the forgotten way Americans obtained loans reminds us that finance has always been built on one timeless question: who can be trusted? The answer has changed dramatically over nearly 2 centuries. It began with neighbors, merchants, and handwritten promises. It evolved through nationwide reporting agencies, expanding banks, economic crises, and technological innovation. Today, trust is often represented by numbers on a computer screen. But behind every financial system, whether based on a handshake or an algorithm, lies the same human challenge that has existed for generations. Every lender wants confidence that a promise will be kept, and every borrower hopes to be given a chance. The tools may have changed, but the search for trust remains as important today as it was in a small American bank more than 100 years ago.